Okay, let's unpack this enormous deep research report. The turn of 2025 into 2026 was, well, it was anything but a quiet holiday stretch.
Not at all. If you were expecting last year's huge rally to just keep rolling, the market definitely had other plans.
Our mission today is to cut through that noise. We're going to decode the market's really complex recalibration, focusing on three powerful tensions.
Right. You've got the cooling of the big AI trade, this really extraordinary fracture happening inside the Federal Reserve, and then those dramatic shockwaves we saw in the commodity markets.
So let's start with the context. To really get a handle on the volatility that ended the year, we have to remember the sheer momentum of 2025.
It was a monster year. When all was said and done, the Nasdaq was up over 20%, the S&P 500 gained roughly 16.4%, and the Dow was up about 13%.
But those numbers alone are a little misleading, aren't they? Because the growth was so incredibly concentrated.
Exactly. It wasn't a broad rally. It was all driven by a handful of these AI-fueled leaders. You saw just stunning, concentrated gains.
Like Micron.
Oh, Micron's stock was up a mind-boggling 239% for the year. Then you had Palantir up 135%, AMD up 77%. Even the giants like Alphabet and Nvidia saw these huge double-digit returns.
That kind of performance is just, it's historically rare. It signals a market that's really betting everything on one single idea.
Which, of course, means not everyone got an invitation to the party.
Right. When you look at the laggards, sectors like consumer staples, real estate, they barely moved. They were up only 3.7% and 2.7%.
And that massive divergence supercharged tech on one side, stagnating staples on the other, that put immense pressure on the central bank. It leads directly to what we saw at the Fed.
The Federal Reserve's December 10th meeting. It felt genuinely historic because of that division.
It really was. The Fed delivered its third straight 25 basis point rate cut. That dropped the short-term target to a three-year low, between 3.5 and 3.75%.
Now, usually a rate cut signals confidence, but the vote itself told a completely different story.
A very different story. This is the key thing for you to remember. The vote was a rare 9-3 dissent.
The highest number of dissenters since 2019. That's not just a disagreement, that's a fractured consensus.
And the dissenters weren't even on the same page. The policy divide was stark. Two of them wanted to hold rates steady, arguing core inflation was still just too persistent.
But the third one, Governor Stephen Micron, he wanted to go the other way.
He wanted a deeper 50 basis point cut. He was looking at a rapidly cooling labor market and saw that as a much bigger risk. Powell himself had to admit the Fed's dual mandate was, and I'm quoting, a bit in tension.
When the Fed is that divided, its forward guidance just becomes so much less reliable, which creates huge uncertainty.
And the market had to swallow that uncertainty heading into the end of the year. Looking at those last few days, December 29th to the 31st, the indices just limped to the finish line.
4 straight losses for all 3 major indexes. And get this, the S&P 500 narrowly missed extending its 7-month winning streak, missed it by less than 0.1%.
That's brutal, just brutal. We did get a bit of good news on the labor market on the 31st. Jobless claims came in lower than expected at 199,000, but the big market question was still just hanging there.
And that question came to a head on January 2nd, the first trading day of the new year. That's when the divergence became undeniable. The rotation was finally on.
Absolutely. We saw core cyclicals get a boost. The Dow and the S&P 500 both snapped their losing streaks. Money was clearly moving into more traditional value sectors.
Where did that money come from?
It seems it came right out of the growth trade. The Nasdaq finished down again, just fractionally, but that extended its losing streak to 5 straight sessions.
This wasn't just profit-taking. This was the market asking a really tough question. Is all this massive spending on AI software capex actually sustainable if the profits aren't clear yet?
That's the core of the market tension right now. Tangible results are being demanded for all that capital, and that question is going to get louder with the macro data coming this week.
The Fed is watching, so you should be too. We get 3 big releases. January 5th is the ISM Manufacturing PMI.
Right. And for you listening, that's a survey of manufacturers. A number below 50 means the sector is actually contracting.
Then on the 7th, ADP employment. And the big one is Friday, January 9th, non-farm payrolls and the unemployment rate, which is sitting at 4.6%.
These are the numbers that could force the Fed off its current plan of only 1 rate cut in 2026. If the labor market is really cooling fast, Governor Micron's dissent might become the majority view pretty quickly.
It's a really complex web of signals, which is why we spend so much time putting these reports together for you.
And hey, if you are finding this deep dive useful, connecting the dots between a fractured Fed and that sector rotation, we would love for you to subscribe to the channel.
Please like this video and drop a comment. It really does ensure you never miss these reports where we connect the big macro trends with specific stock catalysts. We're trying to help you understand the why behind the moves, not just the what.
Okay, so building on that divergence theme, the start of the year perfectly showed the split between AI hardware and AI software.
The hardware players, the ones building the infrastructure, they had some clear wins.
Huge wins. We saw Baidu shares soar up to 20%. The news was that its AI chip unit, Kunlunxin, filed for an IPO in Hong Kong.
And Baidu owns, 59% of that? So it's seen as a move to unlock value.
Exactly. They're packaging up the shovels and giving them a clean valuation. And then you had this huge symbolic win for Intel.
Intel shares rallied up to 7%. What was the catalyst there?
Nvidia. Nvidia completed a $5 billion private placement, buying over 214 million shares of Intel common stock. That's a massive cash infusion and a huge vote of confidence.
But on the other side of the coin, it was a brutal turn for the software giants.
Oh, it was rough. Microsoft, Meta, Amazon, Palantir, they all dropped anywhere from 2% to 5% on January 2nd.
And that's a direct reaction to the question we just talked about. How long can you keep spending billions if the profit pools aren't materializing fast enough? The market is getting nervous.
And the volatility wasn't just in tech. We saw some massive single-day moves on company-specific news. Take Corcept Therapeutics. It had a devastating 50% drop on December 31st.
50%. In one day. What on earth happened?
Regulatory risk. The FDA issued a complete response letter, a CRL, for its key drug, relacorilant. A CRL is basically a rejection letter.
So they're not approving the drug.
Not in its current form. And what's crucial is they demanded more evidence even though the main trial did meet its primary endpoint. That means the timeline for approval is now totally unknown. It just devastated the stock overnight.
Wow. Meanwhile, the pain just continued in the EV world. Tesla was down 2.6% on January 2nd.
Yep. After missing its Q4 delivery estimates, they delivered about 418,000 vehicles, but the consensus was closer to 423,000.
And worse, that marked its second straight yearly sales decline. That suggests the demand problems are getting worse, not better.
But for a quick positive signal for you contrarians out there, Nike shares popped 4.1% on December 31st. The CEO, Elliott Hill, disclosed he bought $1 million worth of stock.
When a CEO puts their own cash on the line like that, it's a powerful signal of confidence.
It definitely is. Okay, let's shift gears completely over to commodities because this was a shocker. 2025 was a record setter for metals. Silver surged 142%, gold was up 66%, hitting a high of over $4,500 an ounce.
But then, right at year end, a technical correction just ripped through all those gains.
It was a classic liquidity-driven margin shock. Gold plummeted more than 4%, and silver fell between 6.5 and 9% in just 2 trading days.
And the cause was simple but brutal. The CME Group, the exchange, they raised margin requirements twice in less than a week.
Okay, so why does that matter? Why does a margin hike cause a crash like that?
Because so many traders and commodities are highly leveraged. When the exchange says you need more cash in your account to hold the same position, well, if you don't have that cash, you're forced to sell.
A forced liquidation. You have to sell your contracts immediately at any price just to cover the shortfall. And that creates a cascade of selling that just overwhelms everything else.
But despite that flash correction, the long-term outlook for gold is still profoundly bullish. Bank of America, for one, is maintaining an eye-watering $5,000 gold target.
And they cite 3 core reasons. Central banks are still buying, U.S. fiscal deficits are huge, and what they call monetary debasement.
That phrase, monetary debasement, is important for you to understand. It's a polite way of talking about printing money or quantitative easing.
Right, and that historically undermines the value of currencies like the dollar, which drives investors toward hard assets like gold.
Now, if we look at energy and base metals, we see these completely diverging paths. WTI oil is trading around $57 a barrel.
And the outlook there is pretty suppressed. OPEC Plus has shifted its priority to market share, not high prices. So we're expecting a global production surplus of over 2 million barrels a day in 2026.
Which is critical context. U.S. frackers really need oil at $65 a barrel just to justify drilling new wells. So at $57, a lot of that investment will probably just stall.
But then you have copper, and copper is diverging aggressively upwards, pushing toward $13,000 a ton.
So why is copper so hot right now?
It's classic scarcity meeting massive future demand. Supply is tight from things like mine disruptions, but the demand is it's through the roof.
Driven by 2 huge themes: AI data centers, which need incredible amounts of wiring, and of course the global green energy transition.
Exactly. Solar panels, electric vehicles, grid upgrades. It's all incredibly copper intensive.
Okay, finally, let's touch on the bond market. The 10-year Treasury yield ended the year around 4.11 to 4.14%. But what's fascinating is the yield curve. It's in its steepest configuration since 2021.
And a steepening yield curve is the market telling you that the worst fears of an immediate recession are over.
It's pricing in a soft landing.
A soft landing, stable long-term growth, but also persistent inflation. And that belief in stable growth is also why you saw the U.S. dollar weaken over 7% in 2025, its biggest drop since 2017.
So we've got a divided Fed, a technical crash in metals, major sector rotation. What does all this complexity tell us about the outlook for 2026?
The consensus seems to be forming around one big idea, the broadening out thesis.
That is absolutely the key takeaway for you to focus on. After years of performance being so concentrated in those mega-cap tech names, strategists expect performance to broaden out in 2026.
We're talking about a shift towards sectors that have really lagged, specifically industrials, financials, and even mid-cap technology.
And what makes those sectors attractive now?
Well, if the market's right about a soft landing and stable rates, that's great for cyclical sectors. Industrials benefit from steady economic growth. Financials, especially regional banks, benefit because stable rates help their lending margins.
And the baseline expectation is for sturdy global growth, holding at around 2.8%, with recession risk pegged at a manageable 35%.
Right. And in terms of specific AI plays outside the mega caps, you have to look at the infrastructure. A name that keeps coming up is Vertiv Holdings, VRT. They're a key player in the power and cooling systems for data centers.
But we have to balance that optimism with the headwinds, particularly in housing and for the consumer.
For sure, mortgage rates are forecast to stay stuck in the lower 6% range all year. That's still a huge challenge for affordability. We also heard President Trump promise aggressive housing reform plans, which, the market will be watching very closely.
And that brings us right back to the Fed's dilemma. Core inflation is still expected to stay above their 2% target.
And it's complicated by two things mentioned in the reports. First, the effects of existing tariffs keeping costs high, and second, potential impacts from immigration policies that could push wages up, which would also fuel inflation.
So if we look ahead, even with optimistic growth forecasts, the story for 2026 is really a continuation of tension.
It is. The fundamental debates aren't going away. Inflation from tariffs versus a weak labor market, a deeply divided Federal Reserve. The market has taken its profits, and now I think the underlying tensions are really just getting started.
And that is the perfect context for you to navigate these cross-currents in 2026. Thank you for diving deep with us. Now, a quick reminder. Stock, options, and investments carry risk and may not be suitable for all investors. This report is for informational purposes only. Please consult a financial advisor and conduct your own independent research. Always, always do your own research.